Hey everybody, it's Chris Kirkpatrick with Life 180, and I'm really excited for this video today because if you've been following my channel for any amount of time, you know that I'm a big believer in whole life insurance, a properly structured whole life insurance policy being the foundation of your personal and business financial world. Now, as I've been creating a lot of content over the years, there's a lot of people out there who are touting index universal life being a better alternative compared to whole life insurance. And I get a lot of people that respond and comment and question as to why would I go with whole life when these people are over here telling me that IUL can do all the same things that whole life insurance can do and you have more upside. And so the purpose of this video is to actually target out one of those individuals, and his name is Doug Andrew. Doug is a huge proponent of index universal life. He's been a huge proponent of index universal life for at least the 15 years that I've been kind of seeing his content and the research that I've done to kind of go back in time to research him and see kind of how he's run his business and where his successes come from and so on and so forth. And while there are other people out there that are doing this, I'm going to focus this video on Doug Andrew. And so here's the thing. From a high level, index universal life, it's important to understand that while they talk about the fact that it's got, like, let's say upside potential, where they say, listen, if the market goes really high, let's say it does 20% in a year, you're going to gain up to 12%. It's got a 12 or maybe 13%, whatever. Every company is a little different, has a cap on what you can earn. But in exchange for that cap, you have a floor, and that floor is zero, meaning you could never lose. Now listen, I used to work for a Fortune 1000 company that sold index universal life, and I was a big believer in index universal life insurance until I got into this world, until I was the one who had to go out and service all the contracts for people that had previously sold them that were hurting, that were having their policies lapse, that were not having the cash accumulation that they were told and promised and illustrated to them when they purchased it. So what I'm going to do in this video is I'm going to show I'm going to talk about not just kind of some of the things to look out for if you're thinking about buying a policy, but more specifically, I'm going to talk about Doug Andrew, and I want to expose him for his illicit business practices, because I'm a big believer you buy from people. I could sell you a whole life insurance policy. Actually, I can't anymore. I'm not licensed, but let's say I was. And you could go work with any licensed agent at this point in time that could sell you whole life insurance. Not all whole life insurance policies are created equal. Not all index universal life policies are created equal. One of the challenges with Doug is his comments about how the fact is he's the only one who understands how to structure these policies properly. He's the one with the unique ability and the strategies and the understanding and so on and so forth. Now, here's what I know. When you buy from people, it's important to understand the background of that individual. Trust is a huge thing. If you're going to be putting your money into a financial vehicle, if you're going to be trusting an individual with the future of your financial life, you better understand what you're getting involved with and who you're getting involved with, right? So what I'm going to do in this video is I'm going to talk about what does Doug use as kind of his marketing practices, because make no mistake about it, Doug is an amazing marketer. His YouTube channel is having growth. He's written, I think, over 10 books. He's had success, made millions and millions and millions of dollars, I think, from what I've seen. There's no doubt about it. Doug and his two sons that work with him at Live Abundant have been doing this for years. They've been helping people. But here's the deal. They've had a lot of issues. They've actually run into some legal issues. And I think it's important to understand the ethics and the morality of the people that you're going to work with, right? And if you're going to trust them and this so-called person says they're the only ones that understand this, well, this is, fool me once, shame on you, fool me twice, shame on me. And so this is a buyer beware kind of video where I want you to fully understand before you make any decisions what you're getting involved with. Furthermore, if you are an index universal life agent, somebody who believes in that, I want you to understand that index universal life is not designed to be a banking alternative. Everybody who's using it for infinite banking or the circle of wealth or the and asset or anything of that nature, you cannot be using index universal life for those policies because it's not designed for that. It does not have the guarantees. The purpose of having a whole life policy as a banking alternative is because of the guarantees inside of a whole life policy. There are no guarantees inside of an index universal life policy. In fact, that's one of the reasons that insurance companies created Index Universal Life in the first place. Think about it. As time has gone on, as interest rates have gone down, if you understand how insurance companies make their money, what happens is this. They put their money, when you buy a policy, the insurance company puts your money in the general account. That general account gets invested, and they buy fixed assets, corporate bonds, stuff of that nature, where the returns are not super high, but they're very predictable. And now they're having to get more creative to manage the guarantees inside of their general accounts, because they, back in the 80s, they were able to buy 30-year treasury notes getting over 20%, and that was phenomenal. But the thing is, when they buy 30-year bonds, those ladder out in, let's say, 2011, 12, 13, 14, those started to mature. They had to take that money that was in their general account, creating these amazing returns on a guaranteed basis, and they had to start laddering them into other investments and figuring that out. In comes Index Universal Life. Now, mind you, Index Universal Life was not created at that point in time. It's much older than that, in the 90s. But here's the bottom line, is it's become a much more popular and prevalent vehicle for financial professionals to use. Why? Well, first of all, insurance companies are pushing it, because when you buy an Index Universal Life policy, the insurance company is offsetting the risk, the guarantees, to you, the insured. The insurance company is not guaranteeing the cash growth inside of that account. So think about that. If you're using this as a banking policy and you're buying it for those guarantees, and you understand that you're not trying to get the return inside of the policy, but you're trying to use the policy as an and asset, so you can have this, take policy loan against it, invest in real estate, invest in stocks, day trade, crypto, whatever it is for you, having an Index Universal Life policy is just taking on more risk, because the administration costs can go up, the insurance costs can go up. There's nothing that is fixed in an Index Universal Life policy. I want you to understand that as you go through this video and as you see all this. But let's just say it was. Let's just say, I don't want to spend a whole lot of time talking on this. What I do want to talk about is just Doug specifically, and his business practices, and his character, and his ethics, and really his background. So here's the deal. I'm a big believer. I watched a video. I'm not gonna. I'll put a link into the video, but it was a video of him and his sons being interviewed on the news about how to become a millionaire by the time he was 30 years old. And here's the bottom line: his kids, Aaron, I don't even remember his other kid's name, but his two kids are in his business with him, Live Abundant Financial, and I think Paramount Financial is the other company that they own. Everything kind of passes through that. But here's the bottom line. Over the past 15 years, these guys have been involved in lawsuit after lawsuit after lawsuit for getting in trouble for illicit business practices, selling securities when they're not licensed to, doing business in states that they're not licensed to, running illustrations, pushing illustrations through, selling life insurance policies when they're not licensed, going through and selling all sorts of different things. I don't want to go on and on and on. What I do want to do is share the research that I've done with you, because before you get into all of this, before you, make a decision and go down that path, I think you need to understand who you're getting involved with if you choose to go with Doug Andrews. So here's what I'm going to do. I'm going to go through, I found some legal studies, I found some articles, and I want to share the research that I've done with you to make your life easier to vet and to do research on Doug Andrew right here, one video, one place. I will put the links for all the resources that I have down below in the description, and I do encourage you to do your own research, because the bottom line is I believe it's buyer beware, and you should never invest in anything you don't understand, and you should never just take anybody at face value. You should always do your research, including myself. Never just take me at face value. Always go check out anything that I say and vet it, period. And so just take that for what it's worth. So here we go. What I want to do now is I want to get into sharing the first legal case of Doug Andrew. And actually, it's not Doug Andrew. It's Doug Andrew's son, Aaron, who got involved with it, which to me makes it worse, because not only is this guy out there selling and marketing and kind of duping people out of their money to make millions and millions and millions of dollars, but he's out there doing this and he's involving his kids in it. He's like corrupted his own kids into the same sort of illicit business practices, and that's that. So check this out. So I'm going to get into this right now, and I'm going to get into Doug Andrews' legal case. All right, so what I'm going to do here is you can see here, just to kind of go through this. I've gone through this document ahead of time and I've highlighted some of it, you can see. But ultimately, what I want to do is I want to go through and talk about what this lawsuit's all about. Now, you can see here, James Paul Braybrook, he's an individual on behalf of his retirement account, was suing Minnesota Life, which is the company of the product, the Index Universal Life product that he was sold. Aaron Andrew, an individual with Paramount Life Services, Inc., DBA Live Abundant. So Live Abundant, I guess, is the DBA of Paramount Financial Services. That's what I was trying to say earlier, which is a Utah corporation. So that just goes to show. So this is a lawsuit between Aaron and this gentleman who has been ultimately duped out of his money. Now, I've highlighted some things. I'm going to go through this complaint a little bit, but here's the thing. I'm going to link the notes to this down below so you can check it out and you can do your own due diligence. I'm not going to go through every line of this. I think it's 13 or 14 pages and it's pretty in-depth. I would suggest that you go through this and read it yourself. Now, once again, understand, I know that this is not Doug that's in this, but Live Abundant, the company, and Paramount is Doug. He is the owner of that company, and this is Doug's son. Who do you think mentored this guy, Aaron? Aaron has had his ability to sell equities stripped from him. Ironically, he's still allowed to sell life insurance. It's mind-blowing to me. So chances are, my guess is, and I don't know this for a fact, but my guess is if you work with Doug, Aaron's going to be involved in some way, shape, or form behind the scenes. And once you read this, I don't think you're going to be wanting him to touch your money. So you can see here, Paramount, I'm just going to go through and read what I highlighted. So Paramount Financial Services, Inc., DBA Live Abundant, a Utah corporation, is a financial services firm with its principal place of business in Salt Lake City, Utah. It maintains a permanent office in the state of California and at all relevant times was licensed in the state of California to offer and sell life insurance and annuities. At the time of the filing of this action, Live Abundant was not licensed with the state of California Department of Business Oversight to conduct business with California citizens. At all relevant times to this action, Live Abundant was not licensed with FINRA or the SEC to offer or to sell securities to California citizens. That's important to understand. So then going down here, Minnesota Life processed Andrew's insurance applications for a California resident, even though Andrew himself was not licensed to offer or sell insurance in the state of California. So it's important to understand, Live Abundant was in California and was licensed in California, but Andrew himself was not licensed, yet he still was working with this gentleman who lived and resided in California, and he was advising him and coaching him and bringing him through the whole process where he submitted a life insurance application for somebody in a state that he was not personally licensed in. That's a big no-no, by the way. So here we go. Let's get into some operative facts. At the onset of the professional relationship in 2010 and 11, plaintiff informed the defendants that he was a retired disabled U.S. veteran and also retired as a longtime civilian employee working for the United States Navy. He relied on his government pension for his living and personal expenses. Most of his liquid assets were tax deferred in qualified investment vehicles. He had no spouse and no heirs. He derived his annual income from his pension and retirement income, which was approximately $60,000 annual. So what does that mean? He made $60,000 a year. That was his income at the end of the day. He has no heirs, and so on and so forth. So he had a $60,000 income. Keep that in mind, okay? Upon examining the plaintiff's financial profile, Andrew, acting for the defendant, warned plaintiff that his investments were too risky, i.e. the money that he had in his qualified accounts and his whatever were too risky, invested in underperforming investments, and incurred excessive fees. So the defendants, including Andrew, did not inform the plaintiff that the advice violated California insurance laws. So they were not. So what happened is you have an insurance guy who is giving advice on qualified accounts that they're not even licensed or legally allowed to give advice on. especially when it comes to giving advice on a product to sell them into a different product. And that's what's happening with these IULs all the time. That's what these guys are doing. Because when you sell life insurance as an investment, if you really sell it as the investment, which most people that, like I said, sell IUL do because they of the potential growth of 12% or 13%, whatever it is, and the cap at 0, they sell it as an investment alternative to a mutual fund or a qualified account or anything of that nature. A lot of people call it the rich man's Roth because of the fact that, you know, once you make over a certain income, you cannot contribute money to a Roth IRA. And so in a Roth IRA, if you're not familiar with that, you use post-tax dollars you put into an account and you get tax-deferred growth and tax-free access, right? Like that's how it works. And so with an IUL, the money goes in post-tax, it can grow tax-deferred, and you can gain it tax-free through policy loans, right? So it's important to understand, like, that's how they're positioning this is like a rich man's Roth, an alternative investment. And then they look at other investments that they have going on, and, you know, they try to pitch the value of taking money from other accounts and putting it into these types of accounts. So here we go. Let's keep this going. So his investment funds were already qualified, right? Meaning they were already in tax-deferred vehicles. He was elderly and living in a fixed budget without expendable funds to pay the premiums. Remember, he made $60,000 a year. He had no spouse, no heir, death benefit was not needed. He did not request life insurance or a death benefit. Also, the plaintiff's government pension contained a death benefit provision already. It wasn't much. I think it was 60 grand. They'll talk about that later here. The application submitted to Minnesota by defendants Andrew and Live Abundant requested the Eclipsed Index Life Policy, flexible premium universal life policy with fixed index features with a death benefit of $902,000, which whatever, if you're structuring these things properly, the death benefit doesn't really matter. It's the minimum death benefit possible with a maximum cash cash payment into it, which they had annual premiums of $71,900. Mind you, remember, for instance, defendants falsely checked the box. Oh yeah, so they also falsely checked the box on the application saying he had no life insurance, even though, yes, he did have a death benefit of $60,000 already. So they lied on the application on top of everything, all to try to get their story through. So I don't know about you. For me, if people are showing this once, it's kind of like somebody who gets a DUI who complains about it, right? If you get a DUI and you complain about getting caught, chances are, I mean, unless you're like the needle in the haystack that kind of gets caught and it's your first time drinking and driving and you get caught, chances are you probably drank and drive. I think there's statistics out there like 12 to 14 times or something like that before you actually got caught, right? You probably got away with it a bunch of times ahead of time. My guess is, and I don't know, once again, I'm not trying to say this is fact, but I know people and I know how this industry works. My guess is they've probably done this with a lot of people, and this is just the first time they got caught. Defendants sold plaintiff the Eclipse Index life policy, flexible premium on June 24th of 2010. So that's, okay, we're getting into timelines. So the index annuity that the defendants ultimately sold him disclosed the death benefit as $720,000. Now it's important to understand this is an annuity. This is not an index universal life policy according to this, which is interesting. But the bottom line is the principle of what they're doing with people's money to gain the most commission and get the most out of it as possible, right? So, and think about this. It did give him a death benefit of $720,000, which he didn't need. And there's a cost behind that, especially when you do it inside of an annuity. It also bumps up the commission. And the annual premiums on this annuity was $57,413. Now, remember his pay, his income from his qualified accounts and pension was 60 grand. So he's either gonna have to liquidate his qualified accounts to do this. Well, that's the only way he's gonna do it, or he's gonna have to pay for it with cash flow, right? But if he pays for it with cash flow, he's got nothing to live on. And if he liquidates it, he puts it here, he's got nothing to live on. And so, except for maybe whatever income this would derive for him, but then there's gonna be surrender penalties and all this stuff if it's annuity and different things to think about. But here's the bottom line. Both the premiums and the death benefit were less than the applicant's amount that they first showed, illustrated at $902 and $71,000. But either way, it's absurd. It's way high. And it's just ridiculous that that they would even be thinking of utilizing this vehicle in this fashion for this gentleman. It's absolutely absurd. And it just goes to show to me the character of the people. I don't know how any financial professional could come to the conclusion that this was a good idea. Obviously, neither did these people. That's why it's in a lawsuit. From the onset, the plaintiff did not need and could not afford this policy, which are all facts the defendant, through Andrew, had actual knowledge about. He paid the year one premium with most of his small inheritance that he earmarked for his emergency needs. He did not pay the year two premiums, which is going to cause a massive problem because it was unaffordable. He short paid the year three premium with $20,000 from his qualified retirement account. So this guy was in a bad way and had received bad advice and was obviously sold a product that was not the right fit for him. And I guarantee it padded the wallets of the people who sold it because of the way that the policy was structured for commission. These are very front loaded on the commission side, by the way. Based on defendant's recommendation, plaintiff used qualified funds from his IRA totaling $124,000 to pay premiums in year 6, and he paid $24,000 in premiums for years 7 to 9 to maintain his life insurance policy. So it's interesting. They say it was an indexed annuity. I'm wondering if in fact it was an indexed universal life policy or if it was an annuity with a life insurance rider. That part I don't know. We'll have to see. I'd be curious to dig deeper into that. But I've not found information on that because there's a chance it's a typo. I guess it's highly unlikely. But either way, it's garbage. It's ridiculous that this is happening. All these premiums were sourced from his qualified retirement account, a fact that he disclosed to defendants via Andrew, who failed to modify their recommendations upon learning these facts. So what does this mean? Like, what does this tell me? What that statement tells me is the fact that these guys are not out there really coaching people, really helping people build their life more financially efficiently. They are just out there hawking a product to sell you to go get this index universal life policy, whether it fits you or not, period. They just want to sell you products that pad their wallet, pad their commission. Maybe that's not what they do for everybody, but I tell you what, that's certainly a fact in this situation. So let's keep looking at that. All right, so now we get down, by 2015, the life insurance policy was at risk of cancellation because of defendants via Andrew exhausted most of the plaintiff's qualified and non-qualified liquid assets. Defendants were compelled to provide a written supplemental illustration to plaintiff on September 16th of 2015. The supplemental insurance directed plaintiff to borrow money from the life insurance policy with interest accruing to cover the premiums so that the policy would not be canceled. These loans would drive down the death benefit and surrender value. These warnings were not previously properly disclosed to the plaintiff. So once again, you get into these things, there's so many moving parts. That's one of the reasons that I love a properly structured whole life policy, is because what you see is what you get. There's not all these moving parts, and it's the difference in costs are just so ridiculously negligible when you really look at it from a long-term perspective, that there's really no reason to go into buying one of these policies, one of these index universal life policies. There's very few situations I can think where it would be a good fit. So defendants via Andrew recommended that the plaintiff follow their structured cash flow strategy, which was described as a unique financial vehicle that provides a predictable stream of income with a specific rate of return over a specific period. Now, that's garbage. Like, if there's one thing that I can guarantee you about looking at an IUL illustration and the cash flow that comes out of it, nothing is guaranteed about it. Now, a lot of times they'll pitch you on the fact that there are guaranteed income riders that come along with the policy. Well, guess what? Those income riders don't kick in until you start the income stream. So if you're going through and you're popping money into this policy still, and you're adding and you're trying to accumulate money to increase your revenue stream, those guaranteed income riders don't trigger and don't go into the guarantee column until you trigger that income. So if you have problems before you start your income, then you're in trouble. That's where most of these policies run into problems, right? So I think it's important to understand that. And don't be sold on that benefit. Let's see here. This presentation was false and misleading because it was not a predictable source of income, like I said, for a specific rate of return. It was a high-risk, illiquid scheme concocted by defendants to generate excessive fees and lock up investors' retirement capital. That should be bolded, underlined, italicized, capitalized, all that fun stuff, because it just goes to expose. Also in September 2015, defendants via Andrew and Live Abundant recommended that the plaintiff purchase structured interests in future income payments, FIP, as a structured transaction to fund the life insurance premium. So this is where it gets really, really crazy. Defendants did not inform plaintiff that FIP was a high-risk transaction involving an unregistered investment that was not approved by the DBO or the SEC, right? Defendants did not inform plaintiff that this structured income stream was a sales practice violation for an elderly disabled veteran living on a fixed budget. Think about that. These guys know this, yet they still suggest it. It's absolutely ridiculous. So even if they can structure your things and they know what they know, these guys are just not to be trusted. And this is, by the way, this is the first one of like 4 different things I'm going to show you on legal cases and just circumstances that if you still want to do business with these guys after watching this, I'm going to be blown away. On or about December 21st, 2015, the IRA bearing account number, blah, 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 purchased $170,000 in FIP. That's going to cause all sorts of problems for this guy. At the end of the day, you can go through and read all this. Defendant urged plaintiff that the structured strategy was a reliable program to fully fund the life insurance policy in just 5 years. 5-year design. So here's the thing. These guys, what this tells me is that their suggestion and advice is saying you can front load, because a lot of the fees in these are front loaded. If you get enough cash into these early enough, they're going to grow. They're going to be self-sustaining and efficient, and they'll grow, and then you can get tax-free revenue coming out of them. I guarantee, like, that's where they're coming from. So what they're saying is a 5-year design and integrates very well with maximum funded insurance policy. So that's what they're using this for, and they're saying that it's gonna help solve everything. It didn't. That's the bottom line. It collapsed, and so did the viability of the life insurance policy, right? So then he got no cash flow out of it. He had nothing. Like the guy, everything just blew up on him, and so they completely ruined this guy's retirement plan. Ultimately, the plaintiff had no actual notice and did not discover potential misconduct until 2018, when he first lost trust and confidence in the defendants and began his inquiries questioning their advice, diligence, and recommendations. Until that time, he relied on them as financial experts and fiduciaries and diligently followed their recommendations. I mean, why wouldn't you, right? I mean, if you watch Doug Andrews' videos and you read his books and you see all this stuff, it's a pretty compelling story. But the bottom line is, it's not what it looks like. And that's why I'm making this video, because you need to understand that. All right, let's go down here. Let's see if I have anything else highlighted. Yeah, I got something here. So the defendants concealed material facts from plaintiff and misled him and deceived him in all acts discussed herein. Okay, so that's there. Once again, I will link this. You can get access to it. That is that legal case. All right, so here's the settlement. Check it out. So here's the crazy part. So now bouncing over, I'll go down here, I'll scroll down here and I'll just click over. So here's the crazy part. Now scrolling over to here, look at this. This is, so on this one, what I can say is you could see down here that there was a jury demand. I don't know that this has been resolved yet, quite frankly. But I can tell you that it's definitely, when I look at the case and I look at the facts, it's pretty damning for him, and it looks really bad. I'm not a lawyer. I'm not going to give legal advice. Obviously, there's no legal advice to give. Once again, though, I'm a big believer in bodies of evidence, and when you look at the bodies of evidence and how these things are going to be stacking on top of each other, this is Aaron Andrew, Doug's son, who is involved in all this. And here's the crazy part. This is just where it starts, because that was him. Now what's going to happen is, let's go to this one. It's Eddie Cressy, who is, I believe, the lawyer for a class action suit. against Fidelity and Guarantee Insurance Company, Paramount Financial Services, and Doug Andrew. So now here's a legal case, a class action case against Doug Andrew. So check this out. Once again, I will link this in the description for you to be able to check it out because I think it's really important. But you can see here, I'm going to go through this and go through some of the things that I catch. I was not able to highlight this one just because of my software. Wasn't able to. You can see this is kind of a different type of downloaded PDF. But anyway, so this is an insurance class action brought by plaintiff Eddie Cressy on behalf of persons who purchased index universal life insurance policies issued by the defendant Fidelity and Guarantee. OM Financial Company alleges that Paramount Financial Services and Doug Andrew, collectively the defendants, marketed and or sold IUL policies as investment products, failed to disclose the high costs associated with the IUL policies, and encouraged customers to obtain a mortgage or equity line of credit and to use the proceeds to purchase IUL policies. Called this the misfortune strategy. Now, if you know anything about Doug Andrew, you know he wrote a book called The Misfortune 101, and there was a strategy in here, and this strategy is ultimately what led to basically refinancing or taking equity out of your home and then putting it into an IUL to have it grow and creating more opportunity for your wealth potential through an index universal life policy. Very, very dangerous, and it came back to bite him. So, based on these and other allegations, the complaint assured causes of action for unlawful, unfair, and fraudulent business practices, Business and Professions Code, unfair, deceptive, and misleading advertising, breach of fiduciary duty, and fraud. So that's that. Let's see here. If I go down through, there's a bunch of different stuff here, man. It's crazy. So this goes through like kind of what they're looking for settlements. Once again, I'm going to link this up here. I think it's really important that you see all this stuff. The part where they're talking about fraud, marketing practices, illegal marketing practices, or unethical marketing practices, to me, it's one of those things where this is who this guy is. He's a con artist. He's good at pitching people concepts. He's great at marketing. He's great at telling the stories, because the bottom line is, if you look at an index universal life policy, it's kind of like looking at the return in a mutual fund. You can look at it over a period of time and it looks like it's going to be really good on paper if you project it out, but they never seem to perform the way that they look like they're going to perform. And that's the problem. Index universal life is actually worse because there's insurance fees and all these other administrative costs inside of it that are pulling out your money and your capital and hurting the opportunity for it to grow. All right, so here's the deal. Here's a class action for you. Numerosity. There are approximately 66,918 class members in this class action suit. 46,115 active IUL policyholders, 20,803 inactive IUL policyholders. See the supplemental briefing. Thus, numerosity has been sufficiently established. This is insanity. He's got 66,000 people that have gone through and filed a class action in this situation, in this lawsuit that Doug Andrew is specifically named in. You cannot trust a word that's coming out of this guy's mouth. It actually, like, I love it when people are successful online. I love marketing. I'm a business development guy. I really have a passion for people doing this. But it kills me to see somebody like Doug get successul when he's just lying to people and stealing from people. This is just mind blowing to me. So it goes through on why it's the case, and I'm gonna link this down here. But here's the bottom line. It goes into cost of fees and all these different things. And it's going in September 2014. That's another case. So listen, this is another case for you to look at, but it's not the last one. I got another couple things to show you. So here we go. The Securities Exchange Act of 1934. You could see the matter of Aaron Andrew So this is Aaron Andrew. So this is going to, once again, I'm putting all this together because I'm just finding legal documents with these guys all over the place. It's mind blowing. And if I don't know about you, but if I'm putting my money with somebody, I'm not gonna go trust anybody's advice when there's legal documents all over the internet with their names on them, saying that they're scamming people out of money and they're getting their securities license taken away from them and all these things. It's just disgusting. So in this, you can see Aaron Andrew was found guilty ultimately, and they penalized him. I will link this below. I'm not going to go through this line by line, but it's a pretty short document. I would suggest everybody read that and go from there. All right, so I also found this article on Investment News. Now, if you're not familiar with Investment News is one of the most reputable news publications in the financial space. And so you can see here the title, Banned from Selling Securities, but Still Hawking Insurance. Notice the term. 3 salesmen barred for selling Woodbridge Ponzi scheme still have state licenses to sell insurance. It goes down in here. Aaron Andrew listed as part of it. And you can see here, Aaron Andrew work in Colorado and Utah, other guys in Texas, blah, 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 blah. But they each made between $776,000 and $2 million in commissions from selling the Woodbridge Ponzi scheme, according to the SEC. So once again, these guys had the SEC come after them while they were doing these practices. I will link this if you want to watch the full, read the full article. You can look down below in the description. Once again, that's that. Now, actually, yeah. Before I come to this, I want to show this article or this page. Now, this is the Laser Fund. Now, I'm telling you this because it's interesting. I'm like marketing his material for him, but it's just part of that buyer beware conversation. Doug is a master marketer. I'm not gonna cut him down at the knees about his ability to market a product because he's obviously very amazing at it. I got to give him credit for that. He's got this book. It's the Laser Fund. I'm gonna be transparent. I just ordered the book, but what I can tell you is I guarantee this book is exactly like all of his other books. It's gonna be the same stuff. Talking about, if you look at the information that he writes about in the copy on this, it's all the same concept. It's about how to create, the Laser Fund is going to be about how to utilize and market and leverage a properly structured index universal life policy to avoid all these other, avoid taxes, grow tax deferred, have tax-free access, why take the risk in the market, have the upside potential, downside protection, blah, 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 all the stuff, talking about predictability. Notice the lawsuit. How is this guy legally still allowed to use the same marketing tactics that he's getting busted for and sued over, class actions? Like, I don't understand. Like, the guy, he doesn't stop. It's like he gets busted and he's just like, oh man, like, I guess that song and dance is over. I'm gonna write another book. I'm gonna figure out a different way to position the same old stuff and just find a new set of suckers to buy into my stuff. Like, that's exactly what this guy is doing. And so, like, I just think it's important for you to go through this. Gloria, I love these reviews from people. Review 205, 111. I guarantee you this is all bullcrap. Like, these people are not real. If they were real, they'd have pictures. They'd have people on video that were willing to give their testimonial. They're giving fictitious numbers just to sell you on it. 3-dimensional wealth. This is all garbage. Like, buyer beware. I ordered the book. I'm going to read it just because I read everything just to kind of get an idea of it. I ordered it. I'm going to read it. We'll see how it goes. I'm going to go through his process and really, sense this guy out and see what's going on. But buyer beware. Now, here's the last thing I want to show you. The Better Business Bureau profile for Live Abundant. Now, right here, caps, like right at the front. This guy, it shows that they're involved in a lawsuit with the SEC, right? Right here, bang, check it out. You don't want to be working with somebody who's in a lawsuit with the SEC like this, not on this level. Get involved with an operating Ponzi scheme of $1.2 billion. Like, it's 13 individuals are charged among Woodbridge's top revenue producers, selling more than $350 million of its unregistered securities to more than 4,400 investors. So these guys made a ton of money. I've already talked about that already, but this is just kind of going to show, you know, what's up. I just, reviews, like look at the reviews. 1 star, this company is fraudulent. Okay. These morons are evil. I'll let you come back and read. I'll link this again. I too will not see much of my 2 investments. They obviously lost money in the Woodbridge thing. That's sad. Don't want to laugh at that. Because of Live Abundance Wealth Architects, my husband lost his retirement savings, and we don't know if we'll ever recover from this loss. Hundreds of seniors and others have been similarly affected by their business practices. Look at this, guys. Like, aside from the Ponzi scheme, Live Abundance sells Index Universal Life products. None of the claims Doug makes in his presentation on the radio are true. Okay? This is, guys, this is all investors, fair warning. Yes, you, me, others. Anyone that remotely believes this firm to be legit, yes, they sell hope and opportunity. They are wealthy. They promote family, faith, and lifestyle. They're incredible, likable, and convincing. Fair warning, check yourself now before your money is gone. Ask for proof of broker licenses, proof that transactions are legal, proof that the custodian they select is legal, legit. Think about it, like, this is insane. Like, I've never seen, like, I don't know if I'll be able to find anybody out there on the internet that is so public and prevalent in their marketing, you know, on YouTube and in other sources that is such a fraud and such a scam artist, yet somehow everybody seems to love what they're putting out there. It's, I really just don't understand what's happening here. Oh, 1 5-star review. I bet that's an employee. So, anyway, that's that. Like, I had to show that. It's unbelievable. It once again, just buyer beware. So I've got all this information down in the queue, or down in the description below. And so all the links from the legal cases and all the articles that I found, I want to make your life as easy as possible. I'm going to link them down below and just use them. All right, so this is another article that I found by Ray Quinney and Newbucker. I think it's a law firm, talking about Ponzi schemes, why Utah is involved with so many Ponzi schemes. Well, guess what? These guys, they talk about creating people's wealth. These guys are just looking for an angle. They're looking for an edge. They're looking for a way to build their business in any way they can and create revenue for themselves, not for you. And it just goes to show that this is the case. So Doug Hronek first heard about Live Abundant while listening to his car radio. Doug has a radio show, and he ended up investing nearly $500,000 in a Ponzi scheme through Live Abundant. So once again, I'm just telling you, like, all this is out there. This information is out there. It's all very relevant. It's all very easily to access. What I want to focus on in ending this is just encouraging you to really think about who you're working with, what you're doing. Make sure that the philosophies that you are getting involved with actually make sense. I know there's a lot of people out there. There's a couple other people that I'm going to call to the carpet on this as well, who are out there doing illicit Index Universal Life practices that I think are putting a lot of people at risk, and they're doing a lot of marketing. They're having a lot of success. And once again, I don't look to hurt anybody as far as like success, but I feel like I have a responsibility with my channel to inform people about what's what. And when I start getting a lot of comments on my YouTube channel about, you know, why would I use a whole life policy when I can use an Index Universal Life policy and it's so much better? Once again, certain Index Universal Life policies are fine if structured properly and if done the right way. You want to make sure you work with the right people. And unfortunately, the people that you find marketing Index Universal Life just happen to be shady for the most part. I've got a couple other people that I'm going to be bringing, that I'm going to be creating videos on here in the near future, that are big in the Index Universal Life marketing space, online, on TikTok, on YouTube, on all these different places. And they need to be exposed, because I feel like I have a responsibility to protect you, the consumer. And if you're a life insurance agent, I feel like a lot of people watch my channel because you want to be educated about how to do whole life insurance properly, and that's fantastic. I always encourage everybody though to verify everything, right? Whole life insurance is safer because it's fixed. There's not all these moving parts that you can kind of bait and switch people with. There's no smoke and mirrors. It is what it is. What you structure it as, what you see it as is very straightforward. As you saw in the legal proceedings that I just showed you, that's not the case with IUL. There's a lot of bait and switch tactics. There's a lot of different ways that you can misinform the person you're selling, and they don't understand it. And so what I'm going to be doing is really doing a series here on people who are doing things illicitly online when it comes to marketing practices for Index Universal Life, and really bring to light how those practices are functioning, and depending on the individual, whether some of it's going to involve the individual's character and their background and history, like Doug Andrew here, because this is just ridiculous. And some of it's just going to talk about the actual strategies and calling to account, all that, all the different moving parts and the ideas, like the Misfortune 101, taking equity out of your home to put into an IUL, like what he did with the guy to get that loan from his qualified account for $170,000 to fund 5 years of the premium, and it still blew up, and they pitched it as this guaranteed safe way to go about funding this policy. It couldn't be further from the truth, right? And it was a security that they shouldn't be selling in the first place. They get involved with all sorts of different things. I mean, there's another lawsuit here. Actually, I'm going to show you real quick before I go. You can see that Courthouse News Radio had Doug Andrew sued for $427,000. Look at this. So this is important to understand. Doug, and this is 2012. This is way back, then. Salt Lake City, Doug Andrew, radio host, author, and sponsor. Misfortune, Isn't It Time You Became Wealthy, is in financial distress and owes a Utah limited partnership $427,000 the LP claims in court. I haven't been able to find any rulings on this, but once again, I see a common practice here. You want to work with somebody who's trustworthy with your money. This guy is anything but trustworthy. I'm telling you. So Mellings claimed Andrew borrowed $668,000 in 2008 and promised to use the money to pay premiums in life insurance policies and expand Paramount, but defaulted on the deal in May. Andrew is the author of Misfortune 101, Millionaire by 30, and New York Times bestseller, The Last Chance Millionaire, It's Not Too Late to Become Wealthy. The defendant, Andrew, portrays himself on his radio program and elsewhere to the public as highly successful, wealthy, and successful financial planner. In truth, he is in financial distress and unable to pay his obligations, the complaint states. Okay, so I'm going to link this article in here as well. Well, there's a big part of me that wishes this guy would just go away, because he's just doing a lot of people a disservice. He's hurting a lot of people. It really makes me wonder how he's getting away with it, and how any life insurance company is allowing this guy to sell and represent their products and services. It's just mind blowing to me. Once again, I felt like I was responsible to be able to share this and to be able to bring it to light. If you have any questions, if you have any comments, if you have any information, I mean, heck, if you've been hurt by this man, if you've been anything, by all means, share, comment, reach out to me directly, chris@life180.com. I would be just excited to talk to you, because I'm taking this on right now. I'm on this mission to be able to expose Index Universal Life, and I think the first step of it is, on top of the videos that I've already done talking about why Index Universal Life is not the best option compared to whole life, there's people out here like Doug who are saying that it is, that Index Universal Life is awesome. But now I've showed you the case that this guy is just, he's a quack. He's not to be trusted, and he's not somebody you want to put your financial future in the hands of. So anyway, I hope that helps. If you found value in this video, please hit that like button, hit the subscribe button, share this video with people, because I think this guy needs to be exposed. So please share this. Like it, hit the subscribe button, that way you get, and hit the bell, that way you get notified every single time I put out a new video. Like I said, this is going to be the first of a series. I may do more videos on Doug. I I've got a couple other people that I'm going to be putting videos out on Index Universal Life, and I'm going to be doing more in-depth videos on comparisons of Index Universal Life and whole life insurance and which one works for who, right? Keep in mind, I'm not a licensed person. I just happen to be in the business for a long time, and I was the head of business development for an Index Universal Life company that did both whole life and Index Universal Life. So you're not going to find anybody else out there that has an interest to share with you, or the heart to share with you, without the self-serving interest of actually selling you a policy in the first place. So I hope this serves you. I hope you found value in it. I hope you have a blessed, inspirational day, and I look forward to talking to you soon. Take care.